All right. Okay, this is going to be an options workshop, and we're going to continue this on. Like we started out with the strangle, then moved on to the straddle, then we did the iron condor, and now we're going to be looking at the iron butterfly. But before I get into all of that, let me get a couple of things out of the way. My name is Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I actually started trading in Chicago. Went to college thinking I wanted to get a psychology degree and started trading with some money I had earned, and then decided to switch it over to finance. And then after graduating, I moved to Chicago to start trading on the floor of the Board of Trade. So I've been trading my own money for well over 20 years now. And one thing I'm not going to tell you guys that I'm going to make you rich or make you a millionaire, but I am here to tell you, to teach you, I should say, to take control of your finances and manage your own risk. At the end of the day, if you're paying somebody else to manage your own risk, that's yield or return on your investment that you guys could be keeping for yourself. So, keep that in mind and take control of those finances. Your investment advisor may very well be doing well for you, but do it yourself also, so you can educate yourself and rate your success against what their success is. Anyway, I've traded in most markets throughout my career. From the Chicago Board of Trade, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. I've seen some crazy times, that's for sure. Anyway, let me go over this disclaimer real quick. Any opinions, news, research, and analysis or other information contained here are material provided by ProTrader Strategies and associate companies or employees, is for general commentary, and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. The reason why I can't tell you guys, hey, this is a strategy or this is something underlying that you need to put into your portfolio today. There's people out there that do that and say, you've got to do this strategy now. I don't do that. The reason why is because I don't know what your risk parameters are, and I don't know what's in your portfolio. So what I'm talking about really could be counterintuitive to what you're already doing or what you even have in your portfolio. So take what we're teaching you here, play around with it a little bit, and implement it into your own portfolio. Keep in mind that I have a pretty high risk tolerance, so it may not be exactly in line with what you are used to trading. Anyway, this is where you can follow us on Twitter. I am at Wolfman's blog, and ProTrader Strategies is at ProTrader Strat. So you can follow me on there for general commentary. Sometimes I throw out my earnings, although I haven't done a whole lot in the earnings in the last several days. So just keep that in mind. And I can't see who wrote to me, but Charles, after the webinar, throw this back out to me when I have a couple of seconds to read all of that, all right? All right. So, like I mentioned, this is going to be on the iron butterfly. Now, if you're on toss and stuff like that, keep in mind when you push this into the computer, and we're going to put this, or into the platform, I should say, it's going to say iron condor. But anytime you have an iron butterfly, that's when you have a straddle with defined risk. And I'll go into all of that here in a little bit. But it is an iron butterfly, and there's a difference between a condor and an iron condor and a butterfly and an iron butterfly. This one in particular is going to be on the iron butterfly, which uses calls and puts. All right, so the iron butterfly, we want a range-bound trade. We want something that's going to be trending sideways, and we also want that to have high volatility when we enter this trade, because the high volatility is going to give us the most bang for our buck. It's going to give us the most premium on those at-the-money strikes. And the reason why we want that is because it also allows us to get the wings a little further away from the at-the-money strikes, for one, and two, when we get that crush, when volatility starts to collapse, we're going to be able to collect our premiums rather quickly. Those premiums are going to decay faster, because what volatility has a tendency to do is to pump up the premiums and hold off that theta decay, and then when volatility comes out, that theta decay really drops. Luke's asking, what's the difference between the butterfly, the iron condor, and the iron butterfly? All right, so a condor is, or let's start off with the butterfly. The butterfly is going to be where you have all calls or all puts, all right? And you're going to sell two, let's just say this underlying was trading at 50, you would say, let's say, sell two 50 calls, buy 145 call, and buy 155 call. So they're all calls or all puts. The iron condor, I did the webinar on that one last week, and that's basically a strangle, which is selling an out-of-the-money call and an out-of-money put, and with defined risk. And an iron butterfly is the straddle, which is selling the at-the-money call and the at-the-money put at the same strike, and then defining that risk. And we're going to go into the details as to how to come up, where I come up with those rules on that here shortly. How do we know if volatility will collapse? What do we look for? I'm going to talk about that here going forward. We don't know volatility is going to collapse, but one thing we do know is volatility reverts back to the mean. That means when it's really low, it has a tendency to go back up, and when it's really high, we're going to have a tendency to have that come back down. The nice thing about volatility collapsing is it happens rather quickly, and we don't always know that we're selling the high in that volatility in that time necessarily, but what we do know is that the probability of volatility coming off when it's relatively high from where it has been is a very good probability. So that's why we try and play it that way, to increase our probabilities of success. Negative 30 degrees in Buffalo. Wow. All right, so like I mentioned this a little bit earlier, an iron butterfly is several things. This way to look at it, I guess, is where you have a short call spread and a short put spread, where those short call and that short put are the same strike. You can look at it as if it's a straddle or a short straddle with a long strangle, which is all a little confusing. The easiest way to think about this is to have it as a short straddle with defined risk. Okay, we're just defining the risk so that we know where our max loss is or max profit. It also makes it IRA appropriate. So that's the beauty in this. It's great for a newer trader. It's great for someone that isn't really sure that this is going to trade sideways or has a lower risk parameter. This is a great strategy. So all walks of life for this. I use this all the time. So I love this strategy, as well as the iron condor, the straddle, and the strangle. If you watch my daily market commentaries, you'll notice that I talk about these quite often. So range-bound market is a very general term. What could you use to determine if we were in a range-bound market? Please discuss. Good question, Trevor. We don't necessarily know, but we can look at like where it has a tendency. Some people use a lot of technical analysis. You could use this with the Fibonacci's. You could use this with just different support resistance levels. Those are pretty easy to figure out. You can see where over time a market has come up and has a tendency to stop at very similar places. That's usually where I look as, if you find two spots where they've come up and almost pegged at the same place, that's usually going to be a resistance area. It doesn't matter if there's a Fibonacci line or anything else. It just has a resistance area. That's where somebody is wanting to unload a lot. And you'll see that also on the downside. And I'll show some examples as we go forward also. Yeah, you can use moving averages and everything else too. And I think there's another question in there. What was moving averages going sideways? Yes, you could. If you saw two moving averages going directly sideways, 50-day and a 20-day, those are usually, or a 50-day and 200-day, let's say, those would likely start to converge on that type of situation though. But you could definitely do that. What was when you talk about implied volatility, are you referring to implied volatility in the stock or implied volatility in the particular option? Is there a difference? Which do we use? We're going to use the implied volatility for the stock, and that is pretty much the same thing. We're not going to be using like the VIX or anything else, because although when the VIX goes up, it has a tendency to pump up all the implied volatilities, but it's the implied volatility for the stock which relates back to the options. And I'll show you guys all how to figure that out here pretty soon, because it is really important to understand. Excuse me. All right, so first thing we're going to do, essentials. These are my steps that I go through for all of these guys. Every time I'm looking at a particular strategy to put in, or whether or not I'm going to be buying an option strategy or selling an option strategy, I go through these, and this will help you become more mechanical. It takes out what's the word I'm looking for? It takes out the psychological part of it. If you stay mechanical, it doesn't allow you to get invested in it and change your mind over and over and let things go wrong, if you will. So anyway, picking the right strike. So basically what we're going to be doing is selling the straddle, right? So one thing with this is that seems pretty simple. You just sell the two at-the-money strikes. Well, we're going to try and create a situation where we're delta neutral. And delta neutral means where we have a zero delta in a sense, so we're not biased one way or the other. We can play around with that a little bit. If you have an upward slight bias to something, I'll show you how to create it so it's slightly biased to that side. But the real thing here is picking the right strikes is we want to collect somewhere close to 50% the width of the strikes. And why do we want to collect 50% of the width of the strikes? That is going to increase our probabilities of success on this. So the tighter you go on these wings, on the defined risk aspect of it, your probabilities of success are going to be much lower, because the underlying will have a tendency to rally above your long strikes, and it will make this strategy not work out. So we're going to play with a little bit wider strikes on that and try and collect somewhere between right around 50% the width of the strikes. All right, picking the right duration. Because we're collecting a credit on this and we're selling those at-the-money strikes, we want something that is going to decay rather quickly. We're not going to pick something really far out in time. We're not going to pick something out in this area, because if this is theta decay, we want this to happen, not really the slow trickle out. The longer you're in this strategy, the less likelihood is that you're going to be successful. So we would rather see this really start to pick up steam and lose that theta, have that theta decay happen. And what I was talking about earlier, see how this theta decay comes down, you lose about 50% of it right in here. If there's a lot of volatility and volatilities come into this market, it is going to push up. It's going to hold off this theta decay from happening. It's going to push it up. It's like a big, huge balloon that kind of starts inflating, and it flattens out this curve that we're seeing. And then when theta decay comes out, you basically, it's like letting go of the balloon, and all that air comes out and it deflates really quickly. You'll see that happen with your theta decay as well. All right. Fitzroy, guesswork, if you're referring to the implied volatility, it is a little bit of guesswork, of course, but at the end of the day, it will revert back to the mean. And usually if you can catch it when it's in the upper band, which means anything above 50% IV means it's in its upper half of where it's been over the course of the year, then it's going to revert back to the mean. Same thing when it's super low, it's going to have a tendency to start spiking up. And that is what you will see happen quite often. All right, picking the right environment. I've mentioned this several times. what we're looking for with this strategy is something that has an ID percent of above 50. That's a pretty hard rule for me. Above 50% IB for any particular underlying. Now, for ETFs or something that is a basket, say the SPY, XLI, XLF, any of those which are ETFs, those type of products have a basket of stocks in them. So you're not going to really see those volatilities really spike a lot in there because they're going to kind of average each other out. So any ETFs, anything above 30 is acceptable with this strategy. So ETFs above 30 or a basket of goods above 30, and stocks need to be above 50. SPX, Bobby, great. Yeah, SPX would be one of those as well because it's a basket of underlines. IWM, the RUT, stuff like that, all of those are. Trevor, if the ID is below 50, that's when I'm going to be looking at buying strategies, although I hate to do it. Usually I'll look at something below 30 for buying strategies for the most part. Okay. So picking the right environment. This is an old screenshot, but this is where you find the IV percent, you guys, right down here at the bottom. So anything above 50 for an underlying like Micron Technologies, and this is a very old screenshot, but it was one of the better ones I could find. Anyway, so picking the right underlying. We need to have something with high volume and open interest. We want something with a tight bid-ask. I think it was somebody was talking about getting run over with a steamroller in a particular stock, and I had, to be quite honest, not really even heard of this stock before. So make sure when you're playing with options that it has a tight bid-ask. And one of the rules of thumb I have for this one right here is when we're looking at different stocks to put a strategy around, is that the underlying, if it is trade or if it's $100 stock or less, the bid-ask on the closer to the at-the-money strikes are within 10 cents of each other. You know, for instance, it would be $1 at $1.10 for the calls, and 95 cents at $1.05 for the put. So something inside of 10 cents. Another thing I talk about when you're talking about the price lines and stuff like that, if you're talking about a bigger stock, like Tesla's going to have penny-wide strikes, Apple's going to have penny-wide strikes. It's over 100. But one thing I look at is, like a $100 stock, it's got to be 10 cents wide, $200 stock, 20 cents wide, $300 stock, 30 cents wide, $400 stock, 40 cents wide. So kind of like along those lines. Put the decimal right in front of wherever it's trading, and that's basically how wide the bid offer should be. It's like basically 0.1% or something like that of what the underlying is trading. So price line would be, say, $1.50 or something. All right, so picking the right underlying. Make sure you have tight bid-ask on those. And with this strategy, know your exit. This is, a lot of people like to take strategies into the last day. I don't do that, you guys. My thinking is you achieve a profit target, get out. And with this one, because we're doing the at-the-monies, those are not going to decay very quickly. Okay, so the at-the-money strikes don't decay nearly as quickly as like the near or the out-of-the-money strikes. Now, for that reason, we're only going to be looking to take about 30% of our max profit. Okay, so if we collected, say, $2, we're going to be looking to exit this strategy when we can buy it back at a, like right around $1.30. So that would be right around 30% of the max profit. So keep that in mind with this. The last thing we want to do is go into the last couple of days, and when you get into those last few days, in this area right here, your gamma risk starts going up, which means as it moves, those prices are going to fluctuate much greater. So especially at the money, that's where your gamma risk lies. So we don't want to deal with any of that. So with this strategy, we're at 28 days right now. We're going to be looking to cover this strategy at 30% of our max profit. Now I do have a guideline, if you will, on something like that where, you know, inside of 10 days, if you got 10% of your max profit inside of 10 days, I'm going to really be thinking about covering this strategy because you've beaten the probabilities. Anytime you can beat the probabilities, take your money and run. Same thing, 15 days in the trade and you're at 20% of your max profit, think about seriously covering that. 25 days into this trade and you got 30% of your max profit, anything 30% or more, anytime I'm getting 30%, that's when I'm looking to cover it. So, you know, if you're in this trade for 20 days and you're at 30%, you're covering it, right? So anything less than that at that profit potential, that's where you're looking to cover it. And I'm even looking seriously, and I've been trying to work out some studies on this, I'm even looking at implementing a time stop where if I'm in a strategy for 21 days, I'm seriously thinking about, especially with this one, covering it because it has really sidelined for 21 days or so. You know, the likelihood, the further out we go, it's going to move, right? The longer we are stuck in a trend, the more pent up it's going to want to be to move one way or the other, and we don't want to let that happen. We'll talk about adjustments. Yes, we will talk about adjustments. Yeah, Trevor, we can do something on taking advantage of gamma. I've got a short video out there on how to trade gamma too that you can check out. All right, so one thing we got to know is what our max profit is. Since we're selling a credit spread, this is a credit spread, we are going to be collecting a credit. That is always your max profit. In options, anytime you sell for a credit, that is your max profit. So we will know that in the very beginning, and we will know what our profit target is because we're going to be looking to try and take about 30% of that. And our max loss, because it's defined, we know that. It's not like the straddle or the strangle where we didn't really know what our max loss is. With this, because it's defined risk, we know what that is right away. And we can calculate it off the bat. And our max loss is going to be one of two things because we have kind of a short call spread and a short put spread jammed together. So each one of those has a max loss. And our max loss is going to be that long call minus the short call. So basically the difference between those minus that net premium. So it's the difference between the long call and the short call minus the net premium. So whatever that is. If it's a $5 wide and we say collect $2.50, we know our max profit is $2.50. Our $5 wide minus that net premium is $2.50, right? So our max loss would be $2.50. Same thing on the put side. Take the difference between the two puts and subtract your net premium from that difference. That is your max loss to the downside. And it's one or the other because the stock can't be in two places at once. All right, and our break even is going to also have two prices, keep in mind. So it's our short call plus the net premium. So in that example, let's just say that we collected $2.50 for the 100 call. As soon as the underlying trades at 102.50, that's our break even. That's right where it is. Anything above that is starting to be a loss. So our short put minus the net premium, so our short put is still that 100 put because we're selling a straddle. Those two are going to be the same, and minus the net premium to go to the downside. All right, so 97.50 is where our break even. Anything below that, 97.49 is where we're going to start seeing a loss. All right, Anybody else have any questions before we get into the trade page? What was that? Can you in the future, would you use the iron fly and not an iron condor or butterfly? All three work in range-bound markets. Yeah, so the butterfly, Trevor, I would most likely be doing the butterfly and something with lower implied volatility for the most part, but they all do work, and I have a tendency to like the iron condor and the iron butterfly more so than the butterfly. Do you add directional bias to maximize profit? Do you use directional? So, in a sense, to answer your question, JQ, do I use a directional bias? For instance, and this is usually where I tell you Bobby's already on it. She knows what my next question is. SPX. So this is where I usually say throw out there in the questions box, you know, some ideas where we can go through the steps for it to see if it fits within the parameters. Amazon, right down here, as you can see, does not have above 50 IV%. So this would be something that would not work with this strategy. And up here in the gearboxes, if you use Thinkorswim, you can type in IV space % and it will give you a section to put it over here. You kind of usually have to move around these things to get it to fit in there nicely. But I always start out with that, and I always have it listed from highest to lowest because I am a person that likes to sell premiums. So it makes it much easier for me to go through the steps. First thing I'm looking for any strategy that I'm collecting a credit for is something above 50, or let's say ETFs would be above 30. So I would start scanning all the way down to 30 basically, looking for that. The other thing is when I'm talking about having a tight bid ask, Amazon is like a $700 stock, but I would look to have this be somewhere within 70 cents, which it usually is, because remember I said just put the decimal point in there, 76 cents wide, so that would be something that I would be looking for that on this, and usually it is pretty darn close to being at least inside of 70 cents wide for something that big. Anything under $100 wide, I'm going to be looking for it to be about 10 cents wide. So Bobby got me on first with SPX. So first thing I want to look at is ID %, Bobby. And you know, last week it probably had a higher implied volatility % on there. So if we go to here, you can see where the IV % was quite high not too long ago. So, you know, that's what I'm talking about. When it's really low, it's going to have a tendency to want to spike up, right? I mean, you will have a tendency to have it spike down, but those are the times where you see it spike down to the lows or spike up to the highs. That's when you want to be either buying when you want, in a sense, you're buying volatility on the low and you're selling volatility on the high. And that's what we're looking for on this. And when somebody was saying you never really know, no, you could, something like in Lilly, where it has continued to go higher. So this would be a situation where I would probably be selling premium in this, and I did, and it went up against me. I sold premium in calls up here, but it went my way. Volatility continued to increase, and it actually hurt me. I was directionally right, but my calls just weren't decaying. And then I went back and started selling some puts when we got back down near these lows. Usually don't leg into to strangles, but in this case it was like, you know, I needed to keep continuing to take advantage of higher volatility is why I did that. So if you watch those daily market commentaries, I explained all that. But this is a situation where you don't really know, and Lilly has continued to increase in volatility. I mean, that's probably some of its highest volatility it's seen in quite some time. We could probably even look at 20-year chart. And as you can see, it has a seriously high implied volatility. So, but enough about that. So one other thing is we could look at with SPY, with that volatility setup. So one thing you can do, this is how you figure out what this is how I should say IV percent is figured out, is a fraction, right? You have a numerator and a denominator. And on the numerator, you take where it currently is trading, which is 13, and subtract that by the low, which is 10. That sum you divide by the sum of where the high is minus the low, and then that's divided by one another. That's where you come up with your percent. So it's where it's trading now in relation to where it has been in the past. There are certain situations where back here in January, February, we had this really high implied volatility, and it's kind of skewed the numbers, if you will, going forward. So one thing, you know, and always be consistent with this, is you could take that equation and always look at it for the past 6 months, let's say, but stay consistent with it, and that will give you a kind of a, because you could say that this is just a big outlier, and it doesn't usually happen. Kind of like with Lilly, you know, Lilly comes back to the norm. That high spike in volatility is going to completely throw off this IV percent for the next year. So that's going to, could very well end up, and as we saw on that 20-year chart, that's going to throw off the math for quite some time. So you know, that being an outlier, sometimes you can look at that and take that out of the way. So with that, SPX, and SPY doesn't have anything. I think all of the stocks pretty much have lost their high IV. So the thing I like to look at is closest to 35 days, and you know, we have to either go all the way out to January, it's most, or the December, which is the quarterlies. But with this one, I'm going to default to near to expiration rather than away, because I want to get in and out of this rather quickly. So in that, I wouldn't normally do this, Bobby, but just because it has such low implied volatility, and I know there's a lot of volume and open interest in this particular underlying, as you can see, so I know that there's a lot of players in there. And the reason why you want a lot of volume and open interest in the underlying is because when things start getting messy, or it starts getting crazy out there, it's good to have a lot of participation, because people are going to run to these that have a lot of open interest and volume in them to get in and out of their trades. So they're going to forget about some of the ones that don't have a lot of volume and open interest, like Lilly, even though there's a ton of volume in that stock on any given day, there's just not a lot of participation in there in the options. Same thing with like Pfizer and stuff like that. It's really hard to get really good markets in some of those. But anyway, we would look to sell the at the monies, and not that I'm going to do it in this one, but when I was talking about with delta neutral, so if we're selling a positive delta, that makes that negative delta. So that means if we sold these calls, it would give us negative deltas, meaning our bias is to the downside on that. And if we sell the puts, a negative and a negative makes it a positive, so that makes our deltas positive. But a negative 50 and a positive 50 deltas would make that delta neutral. And then you would try to make it delta neutral again by doing the correlated, having it pretty close to being on the ones that you're getting long. Okay. Best way to find out direction, daily and weekly. Do you have any pointers? I'm a contrarian, and you know, contrarians have hard lives. So, Scott, do they have a drug announcement soon? I don't know if they have some kind of what's it called? I I don't know if they have the results of some drug trial coming out soon, or what's going on in there, or if there's, you know, rumors of the takeover. I haven't seen anything. I've been trying to look for stuff and I haven't seen anything. So who knows? Somebody knows something I don't, I guess. Because that volatility, I mean, I'm right. I'm still within. I've been able to get those strikes so far away because the volatility is so pumped up that it's not even close to any of my strikes, and I'm just not seeing any theta to get. So it is what it is. Anyway, so Bobby, I probably wouldn't do this. I'd wait till it gets above 30 for something like this. But then you would sell the at-the-monies and try and collect 50% the width of the strike. So I'll look at some others that people are looking at. Let's see, TLT. I think who asked about TLT? Mike. I just did the TLT the other day, and as you can see, I did the TLT. It's gone against me a little bit, but it's not too bad. But this is what I had done. I did the 122s and the 127s. I think I collected around 3 something for it. I'd have to check my notes for it. I don't have it in here right now, but so that was one that I did for the daily market commentary, getting ready for this. I thought with implied volatility as high as it is, that was the time to do it. So check out that daily market commentary for it. You know, I see what you're looking at here. They have Restoration Hardware has earnings coming out. When is their earnings? Let's see, because this doesn't really show it very well. Restoration Hardware. So Restoration Hardware, see, they're going to have earnings, and I would not do this around an earnings event or for the earnings event. I wouldn't even do. I don't even use the Iron Butterfly for earnings trades, and I've done a couple on earnings and stuff like that. Plus, if we look at their bid ask, they have a tendency to have pretty wide bid ask. See, it's a $34 stock, and it's 35 cents wide. So that's one thing. I have it on this watch list because I like to play it for earnings and stuff like that. They do have a tendency to tighten up for earnings, so that's usually when I play that one. But I would wait till afternoon before the release of their earnings for that one. All right, so Luke was saying WLL, Whiting Petroleum. Is this Whiting Petroleum? Is this in Whiting, Indiana? Luke, do you know? Yeah, Whiting Petroleum, OPEC play. So do you think nothing's going to happen in OPEC, right? Amaro says no, it's not in Whiting. So Whiting, Indiana, there's a bunch of petroleum companies right there. That's why I wondered. As a matter of fact, I used to surf down there at Whiting, Indiana, on Lake Michigan, believe it or not. So we're going to try and get this as close to delta neutral as we can, and or the closest to the at the monies. We've got 43 deltas, so this would make you slightly positive deltas, if you notice, when we sell this, at least off the bat. So we would want to sell the 10 calls, and for a $9 stock, having 10 cents wide's a little bit wide for something like that. But anyway, so $1.65. So this is how I usually would set. Oh, and I didn't look to see what is the implied volatility. It's only 6%, so that's something I would skip out of. All right, so I'm just going to bypass that. I think that the bid ask is too wide on that, and the IV percent is way too low. So let's look at Netflix. I don't think they have a high applied volatility either. It's pretty low. Somebody else said Google. delete that. Google's 28%, still pretty low. You know, if it's somewhere right around 50, that's where I'm going to look at it, and you know, I'm going to try and default to the ones that have a higher one. TLT has a higher implied volatility, but I did that one in the daily market commentary. So for those of you guys that were watching that, then oh, Rick, it's Vulcan Oil Properties. Okay. Costco, let's check out Costco. And this is what I do, you guys, every day. I just kind of run through them and see where it is. Costco has it. They have an earnings coming out. Looks like they have earnings. They have earnings on the 7th of December. So that's going to be a part of this. So I don't want to deal with Costco that close to an earnings. What is this? OPHT. I'm not familiar with this one. So it's a $35 stock. This is a perfect example. I would never do this because it's 70 cents wide, you guys. I mean, the reason why you don't want to do this is because to get in and out of this, you have to give up so much edge that you are going to eat a lot of times all your profits. You could be right on this, but you have to give up so much edge to get in, so much edge to get out that it's going to eat you up. We could probably look at the volume and open interest, and when you get something, they seem to have a lot of volume and open interest, which is interesting, but very wide bid ask, at least decent volume and open interest. Do you normally bid at the midpoint? No, especially on something like this. I would never. One thing I tell everybody is when you put it in an order, it's going to default you to the mid price. One reason, they want you to get filled. But another thing is they get paid for you to get filled, right? One thing is if you go to the midpoint or below that, especially if you're just selling a call, it's going to default me right there to the 830. It wants me to hit the bid. So keep that in mind. You're going to get filled there, but you've also given up 70 cents an edge. You know, it doesn't cost you anything to start out at $8.90 in this and then just start walking it down. Cancel, replace, cancel, replace. Same thing with a strategy. Never start out at the mid price. Go above or below, depending on if you're bidding or you're selling it or buying it, and walk it down, you guys. I'm not saying you sit there for 5 minutes and just let it sit. You know, put it in, you know, and by the time you go back into your monitor tab, you do the cancel, replace, go through those steps, you know, the market's going to fill you either right then or not. And then just slowly walk it down. Boom, boom, just keep walking down. And because that doesn't cost you anything. But if you get filled the first time you hit send, that cost you something because you probably could have saved yourself a couple of pennies. And then if you can save yourself a couple of pennies over the course of a year, that, you know, that could end up being $1 or something down the line. So always work it down. It doesn't cost you anything to cancel, replace, but it costs you if you get filled immediately. All right, so somebody else was saying I thought I saw it. I'm going to have to go to some of the ones I've already vetted, I think. 49. So if I couldn't find something, you guys, you know, you can probably bend the rule a little bit on 49. I could probably even go back and say, was that where it was spiking back in February that took it out of line? No, it was actually a little further. But if there was a huge outlier, that might make me want to do it. I haven't looked at Con Inc. obviously in quite some time. It's past the Fibonacci level, but it's come back up and tested this. So, and the market's found value way down here. They must have earnings coming up soon. I can just tell by how far away they've been. And they have earnings also on the 6th of December, so right in here. So I wouldn't want to do that. I don't want to enter this strategy because heading into that, when you're selling the strategy especially, this volatility is going to increase the closer we get to that binary event, as you can see. I mean, sometimes it doesn't happen, but you can see most of the time heading into that binary event, volatility remains relatively high, and we don't want to have to mess with that. All right, can you repeat the bid-ask rule for stocks above or below 100? Anything below 100, I want that to be a 10-cent bid-ask, something tighter. You know, the smaller the stock is, I want that stock to even be, you know, inside of 10 cents. If you're talking about like a, you know, a $20 stock, I want that to be like probably even a nickel. But anything, a general rule of thumb is anything under $100 stock, I want that bid-ask to be less than 10 cents. Something like Biogen, it's a $300 stock. The idea I look at is, you know, it's basically 0.1%, okay, which is, you know, so you multiply this times 0.001, that would give you where that bid ask is, which would be 31 cents. So the idea is just move the decimal place 3 forward, 31 cents for Biogen. Something like, you know, if it's a $700 stock, then it would be 75 cents, right? We just move it 3 times. If it's a $1,000 stock like SPX, you know, then you know it's going to be $1 something wide, okay? All right. Do you sell iron flies after earnings or before earnings? Before earnings, because after earnings you're getting that volatility crush. Unless, like Walmart, something like Walmart the other day, I was looking, the volatility wasn't crushing immediately right after the open, and I tried to get into some things, but it started precipitously falling and started losing that. But we're starting to run out of some time, so let me do a couple that I vetted before the webinar, just kind of looking through, and they're both basically, they both are ETFs. So XLU is one of them, and it's got a 45.9% IV or IV percent. As you can see, it's relatively high. Usually the utilities don't spike. Back in February it did, but usually this is around the high for it, and that's right around where we are. As a matter of fact, it really started falling off today, so it looks like this might be a really good time to get into this. It also has kind of settled down, and you can see after it has a big move, it has a tendency to kind of settle down a little bit, which is what I'm looking for here, at least as of lately. So then we go into the trade page. 28 days I want to default for. You could, if they had 45 days, look at that one, but I also want to be out of this one relatively quick. You can see there's a lot of open interest, a lot of volume, especially these ones at the money. It's a $40 stock. We have penny-wide markets for the most part, which is great. That's what we're looking for. Look at the delta and the gammas. So the closest at the money is 46. So this is going to be the one we're going to pick. This is going to actually make us slightly delta negative. Most likely, I mean, just off of first blush. You can adjust that by the ones you do on the calls. So, but to get this, we're going to look to sell the 97s, or the 97, sorry, the 96, sorry, the 46 strike at 97 and somewhere right inside of there. It's going to give us the mid price. You know, like I said, we're going to kind of jack that up, but remember, we're slightly delta negative because I sold 54 deltas and then I sold a negative 46 deltas, so I'm negative 8 deltas in a sense. Does that make sense? So I am going to be, like it or not, slightly delta negative on this. And if you were more you're worried about the upside, you don't always have to pick that exact at-the-money straddle. You could go slightly out and say we were slightly biased on this or worried more about the upside than the downside. You could sell this one and then sell that one, and that would make us more delta positive on this strategy. Does that make sense? How disadvantageous is it if we are not delta neutral? It's not that much. We're only talking a couple of pennies here or there, and I don't think that it's not really that big of a deal. But if you do have a slight worry to one side or the other. This will benefit more if the market goes up. It'll benefit a little bit faster if you can nail that. But let's do it the right way. So we got $2 wide. So basically on something like this, selling the 46 strike, I know I need to at least get outside of $2 wide to get around that 50 cents. So usually what I look at is if I'm collecting $2, I'm going to at least kind of start at, you know, $4. So I'm going to kind of take the credit times 2 to figure out my starting point. So that would be $4 to the upside. So I would look at buying these 50 calls, and then $4 to the down, or $4 to the downside. I'm going to be looking at buying the 42 calls, right? Oh, 41 calls, right? Yeah, 41 calls. Oh, 41 puts, I mean, because that's 4, right? No, that's 45. Sorry. Long Friday, I guess I can't do math in my head anymore. So $4, that's right. So we've got a $4 wide. We're only getting $1.70. That's a little bit less than, you know, 50% the width of the strikes, right? Because we should be collecting about $2 if it's that far. The other thing to look at is for a whole dollar, it's only going to cost me about a nickel to go down to the 49. So I'll move that down to the 49s, and the 42s I'll move up to the 43s. See what we got. $1.68. So that's slightly over that 50%. So I would probably default for this one. I'm getting $1.68 and I'm risking $1.32. So I kind of like that one. So then another thing you can kind of go back and do is, when we were talking about support and resistance, is we're looking at the 43s to the downside. You know, so one thing you can do is make sure it's within your areas. So we could go to the Fibonacci's. So I got it hooked up on the Fibonacci, and I'm just going to blast this out. I'm not going to worry about it too much being exact. So 43 to the downside is our bottom end, but remember this would probably be right close to where our break even is for the most part. If we're doing the 46 and we're collecting $1, so it's 40. Oh, it's 44.30, so just slightly above. So you know, our break even is going to be up somewhere here. So that should act as support. You know, anytime you're looking at Fibonacci's, and then to the upside, our break even is 47.70. So let's just call it, you know, 48 something. So up here, but our defined risk is the 49. So that is going to act as resistance. So hopefully we could get it to kind of bounce back and forth in here between those two resistance areas, right? Would be the for those chartists that like to use support and resistance. For me, this one looks pretty good. I think it's going to settle down. So that would be one that I would look at for that. And that's how I look to build it out. I go kind of take the credit, go double the wide, and then start bringing it in slightly. Okay, another one we could look at is UNG, which is an ETF for natural gas. I mean, kind of staying along the lines of the utilities and stuff. This 67% is really high. We can even look back at the chart. You can see back in December it was pretty high. Then again here, so we're assuming, you know, that it's going to want to revert back to this mean right back in here. So we're going to think that it's going to want to go back down pretty soon. So having said that, can you set the wings at fib support resistance? You can if you prefer to. I prefer to just figure out what my risk reward is and play it with those probabilities that way, for me anyway. But that's, you can play around with that. So we're 750, so this would be about a pick 'em. So depending on whether, you know, because they're going from 70 deltas, so if I sold these, I would be negative biased. I personally would be upwardly biased with UNG just heading into, you know, the winter. It could have a tendency to start wanting to go up or be biased. I would be biased to the upside. So I would try and get more positive delta in that sense. Okay, so selling those. I've collected a total of $1, so I'm going to be looking somewhere to start at $2 wide, right? So that would put me at the 10s. So I buy those and at the 6 puts to define that. So that's pretty close to the 50. I'm getting right around $1. And then that's exactly where I'd probably start with this strategy because it's given me the mid price is 97 cents. Although the markets in this are pretty tight, I probably wouldn't get that $1, but that's probably where I'm going to start. You know, a few cents above, and for a, you know, a pretty tight market, that's where I would start. If it was one rule of thumb I also look at is, like, say this is 8 cents wide. Take about half of that, so it's 8 cents wide from the natural to the mid price. Go half of that higher, so 4 cents higher than that, which is pretty close to where I'm at. There's a rule of thumb that I usually use for as a starting point, is look where the natural is, where the mid price is, what that difference is, take half of it higher. Same thing on the bid. If I were to be buying this, I'd be looking at the natural, looking at the mid, and going about halfway in between there. And then put that order in, confirm, send, and by the time you get over there, get to the monitor tab, you know, click on cancel replace, go back down, adjust your price, confirm and send. If you haven't gotten that fill, by the time you've done all that, you know, that's about enough time to just work that order. So there's so many algos and so many people out there, usually it's going to auto leg something and you'll get that better price if you have the opportunity. I love the way you have the value area to the right of the chart. Is that proprietary, or can you share how you get it there? I actually have done, Mary, a video on how I set up all my platform, so you can check that out. And yeah, so and it's good because even for, let's say, I even talk about how you can do, if you guys are day traders and stuff like that, this is a great way to day trade, I think. And I talk about all the rules on how to do that. So if you like to trade futures, that's a really good one for futures traders. So you get what I'm talking about there. So, you know, figure out what the width of the natural is to the mid, and start about halfway there and just work it down. Okay? How do we decide between an iron fly and an iron condor? Great question. One thing I would suggest is, if you're newer to these strategies, start with the iron condor and then work yourself up, because the iron butterfly is more risk than the iron condor. You're going to collect less for the iron condor than you are the iron fly, but as all things in markets are, the more risk you take, the more you should get paid for that, right? And the less risk you take, the more you have to pay for. So this is a higher risk strategy, which is another reason why, if you watch the Iron Condor webinar, you know I'm looking to take at least 50% width of those strikes. You know, I do have the certain days in the trade where you can look to get out as a guideline, but I'm looking at 50% the width of my max profit on an Iron Condor, because the probabilities are in my favor in that, and you're getting less collection. For this one, you know, if I got 30 cents out of it, that would pretty much be, you know, 30% the credit, 30 cents out of this strategy is going to be about what you're going to get for the Iron Condor at 50% with the strikes a lot of times. So that 30 and 50 are pretty close correlated. And the reason why I like to go for 30% on this one as well is because these ones that are at the money are just not going to want to decay that fast. They're just because of the gamma and stuff like that adding in there, and you've got to fight against that. And the volatility, you know, all of that stuff right around these is going to be higher, and that's going to make this strategy just not decay very quickly for you. You guys have any other questions? That explain it? But Mary, check out the how I set up. It's a really quick video. There's a couple of them actually on it. All right. 30% for iron flies. Yes, that's my target profit. All right, so we're doing this offer again. It's a holiday special, if you will, I guess, since we're heading into the holidays. This is a great price for this, you guys. I mean, there's all kinds of great ones in there, and like using a market profile to trade. I just talked about that. Using for options, and or I even have it in there talking about day trading for futures traders and stuff like that. Somebody else was asking how to trade options using gamma. I've talked about that in this one. So this is the Wolfman's options course. It's a great value. If you want to learn how to trade like a floor trader, that's basically all of this stuff. How delta to measure your odds of winning trade. That's the probabilities. You guys hear me talking about this stuff. I'm always talking about probabilities. I look at it that way. I don't look at trying to figure out the tea leaves of charts a lot more. So I will use that in a sense, but for the most part, I'm trying to play the probabilities after I've gotten to that point. That's what I'm looking at. That takes the emotion out of it if you're playing the probabilities and staying mechanical. And I talk about how to stay mechanical in all of these. How to set up your options screen. I go through all of that stuff. And income generation. How to protect your portfolio against rising interest rates. If you've been listening to what these Fed governors are talking about, they're going to start talking about raising interest rates. And if you have 50%, most people have about 50% or 40% of their portfolio in interest rates. You guys need to watch that video because you are going to see your bond portfolio just get decimated if they start jacking up rates really quickly, especially if you put them on anytime soon. And different options terminology. So this is a great setup. There's over 20 videos in here. Also, if you take advantage of that, you get my daily market commentaries where I talk about every trade that I put on, how I'm staying mechanical. I mean, I just talked about how I had on a strangle in SPY that went against me. I talked about it about a week ago, how I was defending that, staying mechanical, and got out even though it was still against me on the on my short calls. It was still through me. I was short the 216 calls, and it was trading around 218, and I was able to make a profit despite the fact that that call had gone into the money. And I talk about all of that in those daily market commentaries, how to stay mechanical and how to make those trades work by extending duration or whatnot. So talk about all that stuff. So take advantage of this, seriously. Look in the chat window. There's a link to it. It's the options, how to trade like a Wolfman. You can also call us at 310-598-6677 if you have any questions. The other thing is I have a no inbox policy, which means that if you guys reach out to me about anything, I'm going to respond. So take advantage of that. If the trade's going against you, you want to know what my rules are or how I would stay mechanical with it to increase the probabilities of profit, then you can email me. I will get back with you for sure. So take advantage of that as well on the email. So the daily market commentaries and free access to me is also all included in there. Luke, I don't know. how long the program is for you. You'd have to talk to somebody. You can reach out to somebody at Pro Trader Strategies and find out about that. Right? Are the commentaries emailed each day, Rick? I should talk to Patricia. She's in charge of the emails, but I believe they are emailed out every day, or you can go on the website and it should be part of your course in there. The way they do it for me is I go in there on the website, log in, and they're there, but I don't know if that's the way it's all set up for everybody. So email us or give us a call on that, Rick. Okay, Scott bought it last week. It's good value, thanks. All right, thank you, I appreciate that. Are you trading after Tuesday next week, Eric? I'll be trading, yeah, I'll be trading Wednesday and probably going to take Friday off. Used to trade on the Friday after Thanksgiving, but I don't so much anymore. Please go over the closeout process again. 30% of your max profit. So we know what our max profit is. That's the credit we receive. So in that last example I gave, it was like, you know, $1, let's say. So I'm going to be looking to cover that strategy when I can pay right around 66 cents, right? Because that's a third or 30% of $1. So, or actually it would be 70 cents or 66, third the width of, or third of that. So it would be about 70 cents. Sorry, my math was wrong earlier and confused anybody. But I'm looking to take 30% of that. So if it's $1 credit, I'm looking to take about 70 cents. If it's $2 credit, I'm looking to take $1.40, or buy it back when I can pay $1.40. So I collected $2. 30% of the max profit would be 60 cents, so I'd be paying $1.40 to get out. Does that make sense, Tony? So the link, yes, the link to this should be in the chat box there. Do you have any different strategies or general information about options? Yes, that's all in here also, and there's access to other stuff. Give us a call. They can lead you to the all of the stuff. I have over, I think, close to 100 videos at this point. Yeah, check the website, or reach out to me, Rick. I'll look into it if you haven't been getting those. Can you go over the adjustments? I'm going to be doing that next week, so that's going to be a whole webinar on how to manage your risk with these. So Trevor, that's the same thing. So look in the you'll be getting an email if you've signed up for the webinar. How to set up the trade platform, that's in this whole thing also. How to set up the trade platform the way I have it, using with market profile and setting up the screens, everything else. Do you prefer trading on the floor or trading via computer? The floor, I prefer trading on the floor. It was a great time. I mean, it's basically a room full of guys just, talking and having fun, and then getting serious when the market would get busy. So I loved the floor. Although I am getting used to trading on the computer, it's not as bad as it once was. It used to drive me crazy. Any defensive moves or bailout beyond break even. With this defined risk strategy, I usually, well, and I'm going to talk about that in the webinar next week on how to defend those, but I usually let it go. All right, so one last thing here. So check in that chat box, that's for the link there, and ProTraderStrategies.com options course, how to trade like the Wolfman, is also the link here. You can't really click on that, but I want you guys to have access to that. And other webinars, we're going to be drilling down on different options components and how to trade options, trades I find, when and where I find them appropriate. Trevor, remind remind me, send us an email on the one that you wanted to talk about. Thanks for watching, you guys, and reach out to us, 310-598-6677, or email us any trading ideas, or if you guys signed up, reach out to me if there's a trade that's gone against you. You can reach us at trading@protraderstrategies.com. All right, so I'll go over a couple last-minute questions. I know Charles left. Oh, okay, so Charles got answered. All right. All right. Thanks, guys. Yeah, contact the office for more information. And if they can't answer it, they're going to get you off to me. So this webinar is recorded. Oh, one thing I forgot to mention to you guys, watch it again right afterwards so that all of this sticks into your long-term memory. That really helps. I can't express that enough. Watch it again. Even if you got the whole webinar, watch the whole webinar. Watch it again. Thanks, Trevor. I appreciate it. Yeah, they'll be emailing it out to you. It takes us about an hour and a half to compress this. You have to basically convert it and then upload it and then send it. Hey, go Big Ten, go MSU. I'm a Big Ten fan for sure, Rick. I'll be rooting for you guys. One of my good friends is an MSU fan too, so it's too bad what happened to him with falling out. It would be great to have another Big Ten team in the top 10. Go Giants. All right. Take care. I graduated from Purdue. Nice. Penn State alum. Got a lot of Big Teners. Awesome. Okay, guys. Have a great weekend. If you can't take that, take it easy.